Welcome, financial aficionados. Before we embark on our journey into the world of ETFs, mutual funds, and index funds, do us a favor and hit that like button. Here on our channel, we delve into the intricate labyrinth of finance, breaking down complex concepts into easily digestible pieces. Today, we're setting our sights on three financial instruments that are often misunderstood, yet hold the potential to transform your investment portfolio. So, buckle up as we take a deep dive into the world of ETFs, mutual funds, and index funds. So, what exactly is an ETF? Well, let's delve into that. ETF, short for Exchange Traded Fund, is a type of investment fund and exchange-traded product. It's designed to track the performance of a specific index, sector, commodity, or asset like an index fund, but with a twist. Unlike traditional mutual funds, ETFs are traded on an exchange, just like individual stocks. This means you can buy and sell ETFs throughout the trading day at fluctuating prices, whereas mutual funds only transact at the close of the market day. This feature gives ETFs a level of flexibility and liquidity that's quite appealing to many investors. Now, let's talk about what's inside an ETF. An ETF holds assets such as stocks, bonds, or even commodities. The goal is to mirror the performance of its chosen index or sector. This means if you buy an ETF that tracks the S&P 500, for example, you're essentially investing in the general performance of those 500 companies without buying each individual stock. Popular ETFs, there are plenty. You've got the Spider S&P 500 ETF, which, as we just mentioned, tracks the S&P 500. Then there's the Vanguard Total Stock Market ETF, which aims to mirror the performance of the entire US stock market. Now that we've got a handle on ETFs, let's move on to mutual funds. Now, time to tackle mutual funds. What are they? Picture this, you're at a party, and instead of everyone bringing their own snacks, everyone chips in, and the host buys a variety of treats. That's a simplified analogy of a mutual fund. It's a type of investment vehicle consisting of a portfolio of stocks, bonds, or other securities, which are pooled together and managed by an investment company. When you invest in a mutual fund, you're essentially buying shares in this collective pool. Each share represents an investor's part ownership in the fund and the income it generates. Mutual funds are managed by professional money managers, who allocate the fund's investments and attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus. Here's the thing about mutual funds. They offer a way to invest in a diverse range of securities without having to buy each one individually. It's like getting a sampler platter of the investment world. Some popular examples of mutual funds include the Vanguard 500 Index Fund, the T. Rowe Price Equity Income Fund, and the Fidelity Contra Fund. These funds are known for their solid performance and broad market exposure. And that's a wrap on mutual funds. They're all about pooling resources and diversifying investments managed by professionals who do the heavy lifting for you. With mutual funds under our belt, it's time to explore index funds. Next up on our list, index funds. What makes them tick? An index fund is a type of mutual fund or exchange-traded fund, ETF, with a portfolio constructed to match or track the components of a financial market index. The beauty of index funds is their simplicity. They aim to mimic the performance of a specific index. Now, we're not talking about a dusty library index, we're discussing financial market indices like the S&P 500 or the NASDAQ. So how does an index fund work? Let's say you invest in an index fund that tracks the S&P 500. Your investment will rise or fall in tandem with this index. This strategy is called passive investing, as the goal isn't to beat the market, but rather to mirror it. Now, you might be wondering, why would I settle for average? Well, on the surface it may seem counterintuitive. But consider this. Many actively managed funds, where fund managers try to outperform the market, often fail to do so. Meanwhile, index funds offer a low-cost way to diversify your investment across a broad market segment, reducing risk. A few popular index funds include the Vanguard 500 Index Fund, which tracks the S&P 500, and the Fidelity Zero Total Market Index Fund, which aims to provide results corresponding to the total return of a broad range of US stocks. Now that we know what ETFs, mutual funds, and index funds are, let's discuss their differences and similarities. Now, ETFs, mutual funds, index funds. Different names, but how different are they really? Let's dive into the world of these financial instruments and find out. ETFs, or exchange-traded funds, are like the chameleons of the investment world. They mix the best of both worlds, offering the diversification of mutual funds and the flexibility of individual stocks. You can buy or sell them throughout the day, just like you would with stocks. On the other hand, we have mutual funds. Imagine them as a big pot of funds where investors pool their money to buy a diversified portfolio of stocks, bonds, or other assets. Unlike ETFs, they're priced at the end of the trading day, which means you can't buy or sell them during market hours. Then, there's the index fund, the steady player in the game. These funds replicate the performance of a specific index like the S&P 500. They're known for their low fees and passive management, as they simply aim to match the market, not beat it. So what do these three have in common? They all offer diversification, reducing the risk that comes with putting all your eggs in one basket. They're also managed by professional fund managers, ensuring your investments are in experienced hands. However, their differences lie in the details. ETFs offer more flexibility with their intraday trading, while mutual funds provide the simplicity of a one-time, end-of-day transaction. Index funds, meanwhile, are the go-to for those who prefer a passive, long-term investment strategy. Some popular examples include the SPDR S&P 500 ETF, the Vanguard 500 Index Fund, and the T. Rowe Price Equity Income Fund, each representing an ETF, an index fund, and a mutual fund respectively. So, you see, despite their different names and structures, ETFs, mutual funds, and index funds have much more in common than you might think. They provide different paths to the same destination: diversification and professional management of your investments. But when it comes to choosing between them, which one comes out on top? Well, this brings us to our next scene, where we'll delve deeper into which of these financial instruments might be the best fit for you under different circumstances. Stay tuned. The million-dollar question: which is better, ETFs, mutual funds, or index funds? Let's dive into that. Each of these investment vehicles has its own set of advantages and is better suited for certain circumstances. Exchange-traded funds, or ETFs, offer the advantage of being traded like stocks. They can be bought or sold throughout the trading day at fluctuating prices. This gives you the ability to capitalize on short-term price movements. If you're an active trader or someone who enjoys having control over the timing of your trades, ETFs might be your cup of tea. On the flip side, mutual funds are priced only once at the end of the trading day, based on their net asset value. This makes them less susceptible to short-term price fluctuations. Mutual funds are a good fit if you're a long-term buy-and-hold investor. They also often come with a higher level of service, like investment advice and financial planning, which can be beneficial if you're new to investing or prefer a hands-off approach. Index funds represent a middle ground between ETFs and mutual funds. Like mutual funds, they're designed for long-term investing. But like ETFs, they tend to have lower expense ratios. Index funds aim to replicate the performance of a specific index, so they're a great choice if you believe in the long-term growth of the market and prefer a passive investing strategy. But remember, none of these are inherently better than the others. They each have their strengths and weaknesses, and which one is best for you will depend on your individual circumstances. Consider factors like your investment goals, risk tolerance, time horizon, and personal preference for active or passive management. For instance, if you're saving for retirement and have a low risk tolerance, mutual funds might be a better fit. If you're a seasoned investor with a high risk tolerance, ETFs could be the way to go. Remember, the best choice depends on your individual circumstances and financial goals. So, take a step back, evaluate your situation, and choose the investment vehicle that aligns best with your needs and objectives. Well, we've covered a lot of ground today. We delved into the intriguing worlds of ETFs, mutual funds, and index funds, highlighting their unique features and shared characteristics. We also discussed when each investment option might be more suitable based on varying circumstances. Remember, there's no one-size-fits-all in investing. It's about finding what works best for your financial goals and risk tolerance. Thanks for joining us. If you found this video helpful, don't forget to hit the like button and subscribe to our channel. Until next time, happy investing.